We are now looking at economic growth, and this topic talks about how to forecast economic growth rates and precondition for growth, how growth rate can be increased, what drives economic growth, and some of the theories about economic growth. So preconditions for growth are saving and investment, financial market and intermediaries, political stability, rule of law, property right, investment in human capital, tax and regulatory system, free trade and unrestricted cash flows. Describe the relation between long rate of stock market appreciation and sustainable growth rate of the economy. Now, change in price of your index, or how does a stock market would go up? So it depends a lot on the GDP. So equity prices are positively related to earning growth. Economic wide aggregate corporate earning can grow if GDP grow, or if the share of corporate earning in GDP grow. Therefore, the potential GDP of a country, the upper limit of real growth for economy, is important factor predicting the aggregate on equity market. So delta P is equal to delta GDP plus delta E by GDP plus delta P by E, price to earning. So price to earning ratio can also grow, which can cause this change. So price to earning has a lot of expectation like future growth and things like that. So we have kept that. Explain why potential GDP and its growth rate matter for equity and fixed investors. So the relationship between actual and potential GDP may provide insight about both equity and fixed income markets and the state of economy. So when actual GDP growth is lower than potential GDP growth rate, concerns about inflation increase, and central bank is more likely to follow a restrictive monetary policy. So in addition to predicting monetary policy, the relationship between actual and potential GDP can also be underlying fiscal policies. It is more likely for government to run a fiscal deficit when actual GDP growth rate is lower than potential growth rate. So the next part is capital deepening, investment and technological process, and how they affect economic growth and labor productivity. So economies are complex system of many economic input. To simplify analysis, we examine two-factor aggregate model in which Y output is a function of labor, capital and the level of technology. To examine the effect of capital investment on an economy and labor productivity, there is something called Cobb-Douglas productivity function, which says that y is equal to t into k to the power a into l to the power 1 minus a. K is capital and L is labor. A and 1 minus a, or rather alpha and 1 minus alpha, refer to capital and labor's total factor cost. T is the scale that represents technological progress. So Cobb-Douglas function essentially states that GDP is a function of labor and capital output and their productivity. It exhibits constant return to scale. Dividing both sides by L in Cobb-Douglas function, we can obtain the output per worker or labor productivity, which is Y by L is equal to T into K by L to the power alpha. Labor productivity is similar to GDP per capita standard of living measure. The previous equation has important implication about effect of capital investment living cost. Assuming the number of workers and alpha remain constant, increase in output can only be gained by increasing capital per worker or capital deepening, or improving technology, increasing TFP. So however, alpha is less than 1, the capital has a diminishing effect on the productivity self alpha, the lower benefit of capital deepening. Developed market typically have a high capital to labor ratio and a low alpha compared to developing market. Therefore, developed markets tend to gain less and increase productivity from capital deepening. In a steady state, the marginal product MPK is equal to alpha Y by K, and marginal cost, that is the rental price of capital, are equal. So alpha into Y by K is equal to R, or alpha is equal to RK by alpha. So R is the rate of return and K is the amount of capital. RK measures the amount of return provided of capital. The RK is the output measure that is allocated to provider of capital. This is precisely the definition of alpha. So alpha is equal to RK by Y. The productivity curves, it looks like it has x-axis which has got capital per worker, and y-axis has got economic growth. You increase the capital per worker and the economic growth increases, but if you have more technology, the curve is on the top side. It's better for you. So the curvature of the relationship from the diminishing marginal productivity capital economies will increase investment capital as long as MPK is greater than R. the level for which MPK of the level for which K by L for which MPK equal to work happening, deepening stops and labor productivity become constant. So developed countries, the capital per worker is relatively high, so the countries gain little for capital deepening and must rely on technological progress. In contrast, developing countries have low capital per worker. Uh, let's look to the next topic here. Forecast potential GDP based on growth accounting relation. That is Cobb-Douglas function. The growth in potential GDP can be used using the growth accounting relation, which says that delta y upon y is equal to delta a upon a plus alpha into delta k upon k plus 1 minus alpha into delta l upon l, or output is equal to change in technology plus alpha into change in capital plus 1 minus alpha into change in labor, while alpha is the elasticity of output with respect to capital and 1 minus alpha is the elasticity with respect to labor. So growth rate in a potential GDP is a long-term growth rate plus alpha into long-term growth rate of capital and 1 minus alpha into long-term growth rate of labor. In practice, labor levels of capital and labor are forecasted using the long-term trends and the shares of capital labor determined from the national income account. Let's look at a question here. Azikland is an emerging market economy where labor cost accounts for 60% of the total factor cost. Long-term labor rate growth is 1.5%. Capital investment is being growing 3%. The country has a benefit greatly from borrowing. The total factor of productivity is expected to increase by 2%. Potential GDP is 2% plus 0.4 into 3% plus 0.6 into 5%. So that's how you will look growth rate, potential growth rate in the economy. Don't confuse this with the Cobb-Douglas function that we were looking earlier. Although this is you have taken just the differentiation of that and taken d delta y by y, which was tk to the power alpha, so that's the same thing. The next section asks us explain how natural resources affect economic growth and evaluate argument that limited available natural resources constrains economic growth. Then the next topic says how demographics, immigration, and labor participation affect the sustainability of economic growth. So labor supply factors like demographics, labor force participation, immigration, and average hour worked. For most countries, the general average hour work is downward. Possibly explanation include legislation limitation to the number of hours worked, the wealth effect, which includes individual to take some more leisure time, high tax on income, and increase in part-time and temporary worker. So data for Cantico country Asia is shown. Based on this data comments that Cantico demographic changes on its economic growth. On an average, world population grows by 1.2 per year. So they have given us population, labor force participation, median age. Cantico's population grew at an average annual compound rate of 1.8% combined with the increase in the labor force participation, labor supply growth to be aware in the future can tango if those trends continue. The young median age of population also indicates an expected increase in labor pool in the future. Changes in per capita GDP are difficult to predict. Output is expected to be higher due to increase in labor pool, but larger population may then means no impact on per capita GDP. The next topics here is like investment in physical capital, human capital, technological development, and its effect of capital growth. Much more theoretical topic. The fun starts with the three theories that are often seen in the exam. It's classical growth theory, neoclassical growth theory, and endogenous growth theory. Classical growth theory, based on the classical theory, the long-term population growth rate increases whenever there is an increase in per capita income upon the substantial due to increase in capital and technological progress. Substantial level is the minimum income needed to maintain life. Classical growth theory contends that growth in real GDP per capita is not permanent because real GDP per capita rises above the population explosion occurs. Population growth leads to diminished margin which reduces the GDP per capita. This mechanism would provide long-term growth in per capita income. So the important term here is per capita income. So classical growth theory is not supported by empirical evidence. Why we are studying that? Just because we have to understand different point of view. Neoclassical growth theory. Neoclassical growth theory primarily focuses on estimate of companies' long-term steady growth rate, sustainable growth rate, equilibrium growth. The economy is at equilibrium when output to capital ratio is constant. When the output to capital is constant, the labor to capital ratio and the output are growing at an equilibrium rate. So based on Cobb-Douglas function discussed earlier, neoclassical state the sustainable growth rate output per capita is equal to growth rate in technology divided by labor share of GDP 1 minus alpha. So G star is equal to theta upon 1 minus alpha. So sustainable growth rate of output per capita or output per worker G star. So sustainable growth rate of output per capita. We're talking about how much that would look like. Sustainable growth rate of output is equal to sustainable growth rate of output per capita plus sustainable growth rate of labor. So of course those are the two things that should grow. So analysts forecasting steady state growth of country X and Y has collected following information: TFP growth rate, labor force growth rate, labor cost as a proportion of total factor cost. So sustainable growth rate they are asking us. So it's theta upon 1 minus alpha plus delta L, or the growth rate of technology is theta, TFP growth rate divided by 1 minus alpha. Alpha is generally sticking with the first term, which is capital. So labor cost proportion total factor, so that's given to us 1 minus alpha, then plus labor force growth rate. So that is the total growth rate which neoclassical theory goes on. Capital deepening affects the level of output but does not growth rate in long term. Capital may temporarily increase and economic growth rate will move towards steady states. Initial labor capital technology. Steady state productivity is function only of growth and regular labor state. In steady state, marginal product of capital MPK alpha y by k is constant and increase in saving only temporary raise economy. Then we have endogenous growth theory, which is the last model before we move to convergence hypothesis, and why private investments are important. So in contrast to neoclassical, endogenous theory contends that technological growth emerges as a result of investment in both physical and human capital. Hence endogenous, which means coming growth from within technical progress and immense productivity of both capital. Unlike neoclassical model, there is no steady state, so can permanently increase. The driving force behind the growth theory result in the assumption of certain investment TFP linked to technological from society standpoint. Increasing R&D, for example, results in benefits that are external to the firm making R&D investment. Those benefits raise the level of growth for the entire economy. The endogenous growth model theorized that return to capital are constant. The key implication of constant return to capital is the effect of increase in saving, unlike the neoclassical model. The endogenous growth model implies that the increase in saving will permanently increase the growth. The difference between neoclassical is that endogenous theory relates to total factor product, and neoclassical assumes that capital investment will expand as technology improves, like growth comes from increasing TFP, not related to investment capital within the model. Endogenous theory, on the other hand, assumes that capital investment R&D may actually improve the total factors of productivity. So that was the endogenous growth of theory. Then they talk about convergence hypothesis. So it says that empirical evidence indicates that there are large difference between productivity of different countries. Less developed experiences much lower output per capita. The economic question is whether productivity and hence living standard tends to converge over time. Will less developed countries experience productivity growth to match the productivity of developed nation? The absolute convergence hypothesis that less developed countries will achieve over time. The conditional says that it will depend on the saving rate, population growth, the production function. The additional hypothesis is club convergence, unlike the countries may be a part of club with similar institutional features, saving rate. Under club converges, poor country may part of club will catch up. Countries can join the club macroeconomic institution changes. Describe the economic rationale for government to provide incentive to private investment. So the more R&D, the better for you. Then they have removing trade barrier, increase in foreign saving, allowing focus on industries, and these kind of things would help you. So that was in very short about the economics of growth.